In this video, I want to introduce you to the topic of financial management by first exploring what is really the goal for a for-profit business from a financial perspective. The learning objective for this discussion is to address a commonly held view that the financial goal of for-profit businesses is to make a profit. It's something that I've heard over and over. I'm not saying that everybody has that view, but it's the one that I hear most often. And so what I want to do is to dig into that a little bit deeper and help you understand how that's not really the best way to define the financial goal of the business. And so the objective here is that by the end of this discussion, you ought to be able to, for yourself, discuss and explain the shortcomings of pursuing the goal of just make a profit in terms of a for-profit business, that goal by itself has issues. And then I would like you to develop your own statement of what you believe the financial goal should be. And what I would hope is that you would develop this statement by thinking about how you might modify the goal in order to address these shortcomings. And so I don't really care whether you do it in this particular order or not, but bottom line is that you need to identify the shortcomings. You need to figure out how you would address those shortcomings in a modified goal and then sort of state that goal. And it's my belief that if you are able to do this sort of in your own words and understand those issues, that will provide a very good context for everything that follows, because everything that follows in our discussions in this course will be related to giving you the tools and the understanding of how to pursue and be successful at an appropriate financial goal for a firm. So let's first talk about the shortcomings of profit as a goal for a firm. The first one that I want to talk about has to do with this notion of profit versus cash. Let's just focus on cash for a minute. Businesses run on cash. It's not about I'm not here to say that the accounting numbers aren't something that businesses look at and consider, but at the end of the day, the expenses paid to suppliers, employers, so forth, for the operations of the business, so what we'll call their operational expenses, those all have to be paid in cash at some point. They won't accept a revenue number or an accounts receivable number or something to pay those. They expect to have cash. And that cash comes from your revenues, but in an accounting sense, revenues are recognized whenever the sale occurs, not necessarily when you receive the cash. And as I said before, you need the actual cash in order to make the payment. So in a large sense, the distinction that I'm talking about here has to do with timing, right? So with accounting numbers, we sort of distort the timing of when cash comes in and comes out. And yet from an operational standpoint, that timing is very important in terms of us making sure that we can pay the bills. And similarly, if we need to make some sort of an acquisition of an asset, let's say we need a vehicle or we need a building or another piece of equipment or whatever, absent some decision to maybe finance that, we need cash in order to purchase that asset. And sometimes we need both. We might finance part of it, but have to come up with cash for part of it. And again, if we think about it from an accounting standpoint, there's not a really explicit way for asset purchases to read on a balance sheet or on an income statement and be clear on the timing of when the actual cash is going to flow. So collectively, when we talk about cash, these three things, the operational expenses, the operational revenues, and the operational asset investments, which would be both purchases and sometimes you might sell an asset that you don't need anymore, or that it's more valuable to you in terms of what you can get from it for selling it than you get from it from using it. So all of those we would call your operational cash flows. And at the end of the day, your business runs on operational cash flows. So a big shortcoming is the fact that your notion of profit needs to be more refined to think about cash flows, and in particular operating cash flows. A second element of this is your financing cash flows. Financing cash flows are if you borrow money from somebody, and so we would call that a debt, that you'll have to pay them interest on that money, and you'll also eventually have to pay back the amount you borrowed, which is called the principal. If you have equity investors, so stockholders, shareholders that own an interest in your company and maybe have put money into it, not as a lender, but just with the idea that they'll now own a stake in the company, they expect something in return for that. They expect the value of what they've put their money into to go up. Sometimes they might also expect a dividend payment, or they might expect that you would do some stock repurchases, and so explicitly give them cash. But overall, what they really care about is that also their value goes up. So you want to make sure that not only do you have enough cash for the operational cash flows, that you need to leave money left over to take care of these financing cash flows as well. Why is that such a big deal? Well, let's see. If we run out of cash, some bad things can happen. The best possible outcome, so this ought to give you an idea of how bad things can be. The best possible outcome is you just have to scale back your business. Even though you may have tremendous customer demand, you don't have the cash to meet all of that demand, so you scale back your operations to a level where you have enough cash to meet the cash flow needs. And maybe you'll grow out of that, but in the short term, that's what happens. So you reduce your operations. You may have to sell off some assets in order to raise cash to meet your bills or whatever it is. If you can't do that, then you potentially default on some of your payments. Now, there's kind of two different versions of that. There's your vendors or your employees that you don't make good on those payments to. That's still considered a default. They'll take you to court. But if you have a lender and you default on your payments to the lender, then they can actually sue and force you into bankruptcy. And so it's a little bit more extreme, the fact that they can push you into bankruptcy. I don't know what you guys have heard or understand about bankruptcy at this point, but at the end of the day, most debt agreements and most loans from banks to businesses include a clause that basically says if the company defaults on its payments to us, and maybe sometimes it's even more expansive and it says us or any other lender, if it defaults on those payments, then we as the lender have the right to seize control of the company. And seizing control means that we take away its ownership from the equity investors. They no longer own it. And so we as the lender get to make decisions about who the chief executive and the managers are and who gets hired and fired. And so, quite frankly, it's a pretty dire consequence at that point. Doesn't mean the business will shut down, but if you are a financial manager in the business and this happens, it's pretty much guaranteed that you're going to lose your job. And then in the most dire case, you could run into what we call insolvency. Insolvency, from a technical standpoint, means that if we were to take all of the assets that your company owns and sell those off and use that money to pay off all the debts that they have, there wouldn't be enough money to pay off all the debts. And so not only are they just having a short-term cash issue, they actually have an issue where they have borrowed more than they have assets in the form of cash or plants or buildings or whatever else to actually pay off those debts. And in that situation, a lender can also force you into bankruptcy. So it's sort of an interesting thing. Even if you are in the short term are still making your payments to them, this idea of this insolvency, that your liabilities are worth more than your assets in the market, in a lot of cases is enough for them to take you to court and force a bankruptcy. And in that situation, the same things happen. The debt holders take control of the company, the managers lose their job, the equity holders lose their equity. Imagine that you're a for-profit business and you also maybe are the founder of the business, so you hold a bunch of shares in it. You're not only going to lose your job, you're going to lose the value of all of the shares that you have in it. So, not a good situation. So, businesses run on cash, but when we think of profits, we usually try to tie that to some sort of an accounting number. And the problem with almost anything that we would choose, well, really anything we would choose from an accounting standpoint, is it's just not cash. So, for example, if we looked at net income as an example of profit, or sometimes just called earnings, you already have the sort of accrual issue of I may not recognize, I may count it as revenue even though I haven't got the cash yet. I may count it as I may spend the money on it as an expense, but not recognize it as an expense until I actually sell the goods. And so I've got this sort of mismatch in timing where, in fact, I may have already spent the money to make the product and not received the money from selling other products to pay for it, but my accrual recognition will say that I'm profitable. That's not a good situation for you. It distorts the operating asset investments. Again, with accounting rules, generally, let's say that I go out and I buy a big asset, a building or a big piece of equipment. I will not show in the net income the full price of the purchase of that. Rather, I'll stick that over in the balance sheet and I will simply have a piece of depreciation this year for a portion of that. Well, I actually did spend all of that cash today or this year, let's say, but the net income makes it look like, oh no, you're fine. You've got all sorts of positive cash going on this year, and again, simply not an accurate measure. So it's distorted both because it doesn't include the big asset expenditure this year, let's just say. But even in future years, what it does is it adds this depreciation element, right? This depreciation expense that you carry forward that makes it look like you have a cash outflow in the future periods when you really don't. You're actually generating positive cash in those periods. And so, again, doesn't really reflect the how do I manage cash. Can be very confusing. And then lastly, it commingles both the operational and the financing cash flows. Both are important, but when you mix them up, it's sometimes a little bit harder to track. Also, it doesn't really capture all the financing cash flows. It just puts some of them in there. What do we mean by that? Well, net income includes interest expense. It doesn't include principal payments to interest. It doesn't include the money that equity holders want in return for their investment. So it puts some financing cash flows in, but not all of them, mixes it in with the operating cash flows, and so it doesn't give you a number that you can look at and say, oh yeah, we're either good or we're not good. So we'll back off from that a little bit. Maybe instead of thinking of profits, maybe you start with something like earning before interest and taxes, so EBIT. The good news about that is that it does remove the commingling of the financing. Of course, it doesn't have any financing cash flow requirement in it now, so that's not great. But it also removes taxes. Taxes are a real expense. You need to have those taxes in there because that's actual cash that has to go out the door. And it still has the accrual issues with revenue and expense recognition. It still has the distortion of operating asset investments in terms of having the depreciation in there, but not having the full cost of the expense, the purchase of the asset in there when it needs to be in there. So still has all those other issues of net income. So still not great. So maybe we start with EBITDA, which is earnings before interest, taxes, depreciation, amortization. Good news there, it does remove the non-cash expense for depreciation. So that's fine, but it doesn't add back the actual expenditure for an asset in a year when it happens. It does, again, solve the commingling issue, but it doesn't actually solve it by putting all the financing costs in. It just takes all of them out. It ignores taxes, and it still has those other issues related to accrual revenue recognition, revenue and expense recognition. So any measure of profit based on accounting numbers that you might identify has its issues in terms of not really reflecting cash. So point A, company really runs on cash. That's what defines whether or not we're okay or not. This point B, it's not clear what the word profit means, but if we pick any of the accounting definitions that might count as profit, they all have their issues to them. So another point, which we've sort of touched on before, but we'll make explicit here, profit in almost every definition really it ignores the full set of required cash flows to investors. When you start up a business, a for-profit business, typically there's an amount of money that you need to get, whether that's from equity holders or debt holders or however, but there is some amount of investment that's required for the startup, and then there's incremental investments over time. And so you want to make sure that your business is not only just generating enough cash to pay the regular bills, it needs to be paying cash to satisfy those investors as well. So let's take it one at a time. If you think in terms of debt holders, as I said before, at a minimum they want their interest payments, but they also definitely want their principal, the amount that they originally invested, to be repaid. Sometimes that repayment of principal happens in one lump sum at the end. Sometimes it's spread out over several years, but they have to have it. And if you fail to make those payments, that will result in bankruptcy, right? There will be a default. They'll file for bankruptcy. The equity holders will lose control of the company. The debt holders will take over. And usually there'll be a wave of firings, including the financial managers. So not good if you're somebody that's responsible for managing the financial health of the company for this to happen. As I said before, equity holders also require something as it relates to cash flows. Now, they don't just care about, remember that for most equity holders, there's not some amount of money that the company is required to pay them each year. Rather, they simply own a stake in the company. They may own stock, they may own shares of some type, and what they want to do is they want to see the value of what they own rise. Now, they may also like to receive some dividends and so forth, and some companies may commit to a certain level of dividend, but at the end of the day, they want not just that, they want the value of that stock to rise. And that way that stock rises is because the value of the level of cash flows that people expect to have happen in the future rises. So it's one thing to say, well, the value will rise based on us having big cash flows this year, but really nothing fantastic happening in future years. Stock price will rise, but then it'll drop back down. Okay, so that's not great. What you want is sort of this sustained rise, and so what they want is that the managers are finding a way to grow that cash flow year over year over year, and that's what they're really focused on. And so if you fail to achieve this growth in cash flows out in future years and be able to demonstrate to the investors, the equity investors, that's what they should reasonably expect to happen, they may just fire you. It's not that the company goes into bankruptcy. It's just that the equity holders don't like the job that you're doing. You're not giving them what they want. And since they are the ultimate owners of the company, they hire and fire the CEO, and they can direct the hiring and firing of others. And so you may still wind up getting fired. And again, if you do such a poor job of managing sort of cash flows out into the future, that in fact the value of the company stock declines, the value of the assets in the company decline below the value of the debt, then you could have this insolvency that we talked about. And so once again, when you get to that insolvency, that can lead to bankruptcy and firing. So having a goal that doesn't focus on this aspect of the business for a financial manager is pretty bad, because this is the aspect of the business that allows them not to get fired, and the goal doesn't really speak to that. So as the last thing might have pointed out, what that means is that a profit goal probably puts undue focus on current versus future cash flows as well. So it's not just about that it ignores the investors, it ignores them in a particular way by focusing on current profits as opposed to future cash flows. So if an equity holder wants to see the value of the stock rise, they expect it to rise and stay risen, which means that they expect that the future cash flows will be high, not just the short-term ones. And so again, real shortcoming if you're focusing on near-term accounting profits, let's just say, as the worst case, which actually a lot of managers do. That's what they focus on. But if you're focused only on near-term accounting profits and you're completely ignoring actual cash flows and long-term, kind of looking out into the future, those cash flows, not just the current ones, you could be in a real bad situation and not even know it. It would be sort of like using this profit goal. I've used this analogy with people before. Imagine that you're driving a car and it's your job to maintain the car at an acceptable speed. And it turns out that you're not looking at the speedometer, you're looking at some other gauge, the RPMs or the gas fuel gauge or something like that. You're actually just looking at a gauge that is the wrong one. So that's not good. Or maybe your speedometer has both miles and kilometers on it, and you're looking at kilometers when you should be looking at miles, or vice versa. I don't know. So it's just not good if you're focused on that wrong goal. So how might you fix that goal? Well, based on what we said, you should probably have the goal focus on cash flows, not accounting values. It should address the need to satisfy the requirements, the obligations, because it's a legal obligation to debt holders for interest and principal, and that it should also meet the requirements from equity holders in terms of what they would expect to have happen. And it should focus on the value overall, meaning that it's got both a long-term focus and a short-term focus, not just the short-term profitability. And so I leave it to you to come up in your own words with a statement of a goal that maybe fits that requirement. I'm going to throw out my own sort of version of it, and to give you an idea what that might sound like. That maybe the goal should be to grow the value of the business. I put value in air quotes here, as reflected in the value of stock, by ensuring that future operating cash flows exceed the cost of the capital raised from debt and equity investors that's required to fund the business. And so it exceeds the amount that they want back in terms of paying them for that capital. Its cost is what they want in return for that capital. So anyway, your objective here for this lesson would effectively be to be able to come back to me with your own statement of what you think an appropriate goal is, and justify how that statement is, is better than or addresses the issues of profit as a goal. Hope that's useful. Thank you.